My name's Dave DeBow, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewsyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content. Hey gang, if you've ever thought about going from single family homes or duplexes into multifamily properties, or if you're already in multifamily properties and you're kind of sick and tired of third-party management screwing stuff up, then stay tuned for today's special guest. Lee Yoder is a very experienced real estate entrepreneur at this point. He's been in the game for 7-8 years, started with single family homes, built up a portfolio of around 800 units at the moment, and has kind of lived through all of that, going from single family homes into multifamily and going from third party management to in-house management. So Lee, welcome to the show. Great to have you again, my friend.
Yeah, glad to be here, Dave. Thanks so much for having me.
Yeah, it's been a few years since we last interviewed you, so glad to have you back. So let's zoom out, give everybody a little snapshot of what's going on in Lee Yoder's world with threefold investments and what the portfolio looks like today, mid-2025.
Yeah, a year ago, we were sitting at 350 units, and we added a 120 unit at the end of last year and a 415 unit portfolio just at the end of February. So more than doubled our portfolio. Now we sit almost 900 units today. That's in Ohio and Indiana. We manage all of that ourselves. We don't manage for anybody else. We just manage our stuff. And so we're growing. It's very difficult to find deals. This 415 unit was a monster 22 property portfolio spread out all over the place, but got it at a great basis. And that's really hard to do today. It's hard to find great deals. So we decided to take on that mess because the numbers were really good. So we thought, we'll figure out how to manage it and make it work. So we're working on that now. And kind of focus on that a lot right now, making sure our operations are really good. We're managing well because it's tough to manage properties right now. Numbers are really tight. Expenses are up. Revenue's stagnant. So you got to operate really well.
So a lot of syndicators and folks in the multifamily space the last couple of years have been just getting the you-know-what kicked out of them.
Yeah.
Between the value of properties dropping in some areas 20 to 30% for crying out loud. They bought them at the peak. Everything was go, go, go. And interest rates were next to nothing. And then whoop, that changed overnight. So now they're sitting on properties that are worth 20 to 30% less than what they were 3 years ago. And interest rates have doubled or tripled in some cases, depending on what they got in. So a lot of guys are really, really hurting. How have you guys fared throughout this whole multifamily shakeup?
Yeah, it's definitely been much tougher to operate past couple of years than the 2-3 years before that. But we don't have any variable rate debt. We don't have any adjustable rate mortgages. So we've been good that way. I mean, that's probably the biggest way guys and girls are getting hurt is that, they were in the 3s on their interest rate. Now they're in the 7s or at least 6s. And I mean, that just crushes you. Fortunately, we've done all fixed rate debt. So we've got good rates on our stuff, and we've got a year or two before anything matures. So that's been good. But yeah, like I mentioned, I mean, we're here in the Midwest, and, we've kind of been on the top of some lists as far as rent growth. But I'll tell you, Dave, that's not really been our experience for the past couple of years. We've been pretty stagnant. I mean, we were humming along. Rent was screaming higher in 2021 and 2022, but it really came to a screeching halt, and it's kind of been about stagnant since then. Now, we do value add stuff, so our average rent at our property has been going up, but the market rent has not. It's been stagnant. Meanwhile, insurance is way up. Our taxes are up at all of our properties. Our labor costs are up. Materials are up. So it's gotten a lot harder to operate. So we've really had to focus on it, but nothing big. I mean, at least, debt stayed steady, and that's our biggest payment. And we have been able to operate pretty well. I mean, it's been harder to keep properties 95+% occupied. And we've had an increase in delinquency. So we've seen our residents struggle. We're in the C-class workforce housing space. So we've seen our residents struggle. And I think, you follow some of the macro trends, some of the things going on in the economy, and people talk about a K-shaped recovery, that people with assets have done really well because inflation benefits assets, even though you get hurt on the expense side. But people that don't own anything, and that's our residents, they only get hurt by inflation. So we've seen that from our residents. So it's been tougher, but we've been able to to weather the storm for sure. And I think we still got probably some years left before it's boom times again. But I think we'll be able to operate through it.
So I'm not that familiar with your market area.
Mhm.
Have you seen like an influx of new developments coming in and apartments coming on the market, availability coming in? Is that part of it, or is it people moving out or businesses shutting down? Talk about
Yeah.
inflation for sure, but what's happening macroeconomically in your area that's
Yeah, I would say nothing with the business is moving out. I do think I think hiring is a little softer than a lot of people think it is. I think the economy is. I think we're closer to a recession than a lot of people think we are. Maybe actually already in one. That's just my personal opinion. So there's definitely some softness there. Development. We're nothing like the Sunbelt markets, the hotter markets. Midwest is kind of the steady eddy, but we do have more development than normal. So that is challenging. I mean, one of our properties that we have really struggled most with just in that area, it's a part of Dayton, which is just north of Cincinnati. We have had quite a bit of development just in that specific area. So there is some of that. Now there are some hotter markets in the Midwest like Columbus, Ohio, and there's a ton of development there. We don't own there, but I know there's a lot of owners, operators up there really struggling with occupancy because there's so much development. So that's definitely part of the story. I think the economy is part of the story. And I think, just on the expense side, that's the main part of the story for us.
cool. Now, you've decided recently to go from third-party management to in-house management. Tell us the story about behind that, why you decided to make that move. That's a huge move. Like
Yeah,
people
it was.
don't
Yep.
understand. That's a
Yep.
whole new business. So walk us through that if you don't mind.
Yeah, going back to when I first got into multifamily, Dave, I just knew I wanted no part of property management. I want to be an investor. I want to be an asset manager, not a property manager. And so that was really good. I mean, it did help me scale because, I want to say it's a whole half of the business. It's more than half of the business. I mean, that is like 80% of the business is managing the properties day to day, maybe 90. And it was great having a third party do that. And they did a pretty good job. And also I was like, man, I have no idea what I'm doing. But, after working with them for a few years, Dave, I'm like, well, now I kind of do know what I'm doing. I've been working very closely.
I don't know what they're doing. I think I know what they're supposed to
That's
do.
right. That's right. Yeah. We would do a weekly call, and you do that for a few years. You're like, I think I know what's going on. Then you also realize, we for the most part, Dave, just buy 100 units and up because we want it to be big enough for a property manager to sit on site and a maintenance guy to be there every day. And so you start to realize it's those two people that are doing all the work. What if we just employed those people instead of the property management company, right? I mean, it's going to be the same people doing the work. It's just now we manage them. Now there's, a lot to that. But, and then what happened, Dave, was we bought a little bit smaller property. We bought a 64 unit, and it was a little further outside of Dayton. And the property management company that was managing all of our stuff, 283 units at the time, I think, they didn't want it. They said, yeah, that's just a little bit too small for us. We're going to be too expensive. We just don't own anything close enough. We'll do it, but we really don't want it. And that property came with a property manager that lived on site. And the more we dug in, we're like, this guy's doing a great job. Maybe this is the property to try it on. Again, we felt like, okay, we think we know this. All right, let's just try it on a 64 unit. It comes with a property manager, and he was the property manager / maintenance guy. Oh. And so we just said, we'll try it. And so, of course, whether you have one employee or 100 or one property 100, you still have to build all the back end support. You have to find that property management software. So talked with some guys in town, went with AppFolio, got that going, payroll system, just had to build a lot out in the back end. So it was a lot of work, even just a 64 unit, but it really went pretty well. So our next purchase was a 96 unit, and we're like, let's just bring this one in house. And so we did that, and it went pretty well. And then after just a few months of operating those, we said, let's bring the rest of our portfolio in house. And so that was a big undertaking. We did that and didn't buy anything for like a year as we brought everything in. And you're right, Dave. And it was a huge undertaking. It's a lot of work. Before doing that, there were a couple people working with us on the asset management side, but it was almost like we were just like a team, and it didn't feel like I had employees. Once we did property management, it really felt like I had employees, and It's just a totally different game. But when you have good employees, it's really rewarding and it's really fun. And for the most part, we've had really good employees. So it's been good. So I'll stop there, David. Any questions you have? I mean, there was a lot to, some of the frustrations I was having with third-party property management company, but that's kind of the story of why and how we did
What
it.
were some of the biggest frustrations you were having?
Yeah. I'd say the biggest one, the company we were working with, they're one of the better ones in Cincinnati, and they manage about 12,000 units, and they're managing 280 for us. So that's, less than 0.5%. I mean, we're talking about tenths of a percent, right? So we just didn't get that much attention. I mean, and it was so clear when they weren't really paying attention, because then we dropped to 90% occupied, and we look around, no one's 90% occupied. Why are we struggling with occupancy? So we'd kind of kick up dirt and be the squeaky wheel and get mad about it. You could kind of tell they were paying attention, and boom, we're back up to 95%. So it just became clear to me that you just had to pay attention to your properties. And it was just this up and down cycle of them not paying attention, because, they got too many units. They're spreading the people thin. That's how you make money as a property management company, right? You manage as many units as possible with as few of people as possible, and you make as much money as possible. I mean, I get it. It's fine, but it was like, man, if we just brought in-house, we'd only be focused on ours. So our focus would be there all the time. I mean, I mentioned, hey, it's just the girl on site in the office and the guy doing the maintenance, and they're the ones doing the property. Well, like one property specifically, we had a great team. Well, all of a sudden, she just wasn't performing that well. And it's like, man, what's going on with her? Well, they didn't tell us. They brought on another 100 unit, and she was managing that now. So, I mean, it kind of bothered us that they didn't even mention that to us. And then she's not doing as well. And it's like, well, because she's not at our property anymore. And that's fine, Dave. Like that's their company, and it makes sense for them to do that. But I can tell you, we were fine paying her entire salary because she was keeping our property 95% occupied. Suddenly we get to share her salary with somebody else, but now we're 90% occupied. I can tell you that drop, and actually we don't went all the way down to 85. That drop in occupancy hurt us much more than we were saving and sharing her salary. So I'm like, I want to pay her full salary and have her focus on us. So it was things like that. And, property management companies, most of them, Dave, that we've worked with, they are paid based on revenue. They're not incentivized to keep expenses low. No. So they just want to grow revenue. How do you do that? Well, one way you do that is you spend a lot of money on marketing. You spend a lot of money on administrative costs and all this stuff that they're doing. So they push so hard. Also, they don't really care about turnover because they don't care that we have to keep turning the unit. That's a CapEx expense.
That's depending on how they manage it, that might be a moneymaker for them, right?
Absolutely, yeah. I mean, they don't do the leasing fee like somebody. All of a sudden, we see on the back end, well, our property manager was getting these leasing bonuses that like weren't really on the forefront. We're kind of seeing that as like almost administrative expense. So you're exactly right. So just kind of a misaligned interest, which again, nothing nefarious about it. I mean, nothing ill will on their part. Just like, okay, that's their business. Man, if we were doing it ourselves. And then I started talking to some other guys in town, Dave, that manage their own. And it was like, man, they're playing a completely different game. Like they're not running as fast on the hamster wheel because they don't have to drive revenue so hard because they can control expenses. And they're not trying to make so much money off their property management company. They're just trying to make their properties make money. And so ultimately I said, I think we're ready. We just need to hire these people. They cost too much. They're not focused on it every month or every week like we would be. And so let's try to do it ourselves.
Well, that probably makes you more attractive to your investors as well. If they,
I think so.
A little bit more vertically integrated, you got a vested interest in making sure that, the management's as efficient and streamlined as possible.
Yeah, I think so.
Cool. Yeah. So big learning curve with that, taking a year off to kind of get all that dialed in. At what point, so for somebody listening to this, thinking, yeah, my third-party property management sucks, but I don't know if I'm big enough to take it in-house at the moment. What's kind of the sweet spot in your estimation for when it makes sense to take it in-house?
Yeah, man, we have almost 900 units, but Dave, our stuff's so spread out. And so what really stinks about it is we can't share staff. So honestly, I think if you had a couple hundred units and they were close enough together where you could have a property manager at each site, maybe. So you got two property managers and a maintenance tech at each site. So you got two maintenance guys. I think that's enough if you want to do it. Now, if you've been in the business for a while and you feel like you really know it, because the nice thing about that is if one of your property managers is off, the other one can help cover for her, right? If one of your maintenance techs is off, the other one can help cover for them. So that's why I say, honestly, I think if you had two of each and they were close enough together to kind of share, I think that'd be enough. I've heard people say kind of the 1,000 mark, and sure, there's some economies of scale there that would make it even better to bring it in-house. But There are some extra expenses, but it's still less expensive than using third party. And from my experience, so yeah, you have to go get, your property management software, your payroll software. You have to do some of these things, but there's not that much more accounting for just a couple properties. So I think you could start as small as maybe 2 100-unit properties, or maybe you have, smaller multifamily, but you got a couple hundred units. You can afford to have 2 maintenance guys, 2 property managers. I think you get started at that size.
Very cool. Awesome, Lee. Well, it sounds like you're going great guns. That's fantastic. You double the size of the portfolio in short order. That's very, very impressive, especially in today's environment.
Yeah.
Where do you see things going over the next year or so? What are the goals and plans?
Yeah, so that big portfolio we got, it was nice. The seller is allowing us to slowly bring property management house. So they're an owner operator, so they were managing it. So we said, can you guys continue managing it, but let us bring it on slowly? So we've brought in 130 units out of the 415. So we're going to do another batch in September and another batch in October. So it's kind of like we're going to be purchasing throughout the year, even though we're not purchasing. So honestly, man, my kids are in a sweet spot where we're going to do some national parks this summer, take a big out west trip. So we've kind of pumped the brakes. I'm trying real hard. It's hard for me because I always want to grow, always want to be purchasing, but I'm trying to pump the brakes this summer, just digest this portfolio and get out and do some really cool trips with the kids and enjoy that time. And then, I'm hopeful that this fall, winter, maybe we can find our next great investment opportunity.
Awesome. Lee, if folks want to connect with you, where should they go?
Yeah, I'm most active on LinkedIn. That's my favorite social media, if you can call it that. And then, if you jump on our website, it's threefoldrei.com. That's the number 3 spelled out, THREE, fold, FOLDREI is in realestateinvesting.com. And you can find a lot of stuff there at the website.
Awesome, Lee. Thanks for being on the show. Great to see you again.
You too. Thanks, Dave.
All right, everybody, take care. We'll see you on the next one. Hey there. I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewsyou.com.